Chapter 16, Mastering Financial Management. Here are your learning objectives for this chapter. So on one side, the uses of funds dictate the type of financing needed, but on the other side, its activities can undertake are determined by the types of financing available. So careers in finance. Financial sector careers are increasing dramatically. These jobs can include the following: Chief Financial Officer, Vice President of Finance, Bank Officer, Consumer Credit Officer, Financial Analyst, Financial Planner, Loan Officer, Insurance Analyst, Investment Account Executive. But managers and employees in the finance area must be honest, have a strong background in finance, know how to use a computer to analyze data, and be an expert at both written and oral communication. Here's a comparison of short and long-term financing, and we'll be talking about those. Money is needed both to start a business and to keep it going. Here's a visual showing the cash flow for a manufacturing business. So the amounts of long-term financing needed by large firms can seem almost unreal. So the risk-return ratio, the higher the risk, the higher chance for reward. Financial managers must then determine how much money is needed to accomplish each goal and objective. Here are the 3 steps of financial planning. First, we want to establish organizational goals and objectives, budget the money needed to accomplish the goals and objectives, and then identify the source of funds. We already talked about these here. So here's an example of a cash budget. Moving on, you're budgeting for financial needs. You're identifying the sources of funds. Moving on, so traditional banking services for business clients. We, of course, have savings and checking accounts, just like we do for individuals. We have business loans. So we have short-term loans and long-term loans. We have credit and debit card transactions, electronic funds transfer systems, a letter of credit, a banker's acceptance. So here's some sources of unsecured short-term financing. When we talk about unsecured short-term financing, there's not a piece of collateral used for this financing. Most lenders do not require collateral for short-term financing. There's also trade credit, promissory notes issued to suppliers, all kinds of ways to get that short-term financing. There's unsecured bank loans, there's commercial paper. We're skipping the slide. There's loans secured by inventory. There's loans secured by receivables. There's factoring. And here's a comparison of the short-term financing methods. There's also selling stock. We've already talked a few weeks ago about the initial public offering and how that comes about when a business is looking for additional funding. The all-time largest initial public fund offerings for U.S. companies are listed here. So you can sell stock. Also, you can take in money from a secondary market. There's common stock and preferred stock. So common stock is sold or is bought when somebody cares more about the votes or being able to vote than they do getting income. But if you're somebody that cares more about getting the income than the votes, then you choose the preferred stock. And retained earnings is the portion of the profits not distributed to the stockholders. So that's the money that the company is holding on to. They can also take in money from venture capitalists or angel investors or private placements. And then sources of long-term financing. There's financial leverage. We're going to skip this slide completely. So there's long-term loans, like a term loan agreement. There's corporate bonds. The risk-return ratio for corporate bond investors. So the less risk, the bonds with less risk have lower interest rates. If it's a bond with higher risk, of course, the interest rates are higher. Here are 3 types of bonds. And then we have corporate bonds. So any kind of bond is really just a company or a government, if it's a government bond, borrowing money from you as the investor. So if I bought a corporate bond or a government bond, I would essentially be loaning money to the corporation or to the government, and for a certain amount of time. And when that time is up, they will give me back that money I loaned plus a certain interest rate. And here is a table comparing the long-term financing methods. That is it.